welcome to all of you to this morning's In-House in Focus webinar. As you know, today we're going to be looking at insurance and the interplay of insurance with liability clauses in contracts. And for this purpose, we've decided to focus on mainstream supply of goods contracts. I think a lot of you already know me, but in case you don't, I'm Jayne Hussey. I'm a partner in the Mills Reeve commercial team, and my day job, my specialism is supply chain contracting. I'm also responsible for leading the Mills Reeve In-House in Focus programme. So this morning, I'm delighted that I'm joined by Tom Filby. Tom's a partner in our insurance team, so he and I are going to be working together to try and cover this topic. As with all of our In-House in Focus sessions, this session is being recorded. We will be circulating a copy of the slides and the recording to you all in a few days' time. And the recording and the slides will also be posted up on our In-House in Focus hub, which is on our website. Again, those will appear in a few days' time. Another housekeeping point. If you have questions, please pop them in the Q&A function at the bottom of your screen. Just to reassure you, your questions come up as anonymous to everybody else participating. So the only people who can see your identity is Tom and I. It's still open to you to mark yourself as anonymous. The only comment I would make is if we get a lot of questions and we can't cover them all, if we don't cover your question, if you're not anonymous to us, it allows us to come back and follow up with you afterwards to try and answer your question. I always say to you, your feedback's really important to us because that's what helps us to shape this programme and make sure that we deal with topics of particular relevance to you. And when Tom and I were putting this together, we were very conscious that some attendees may be thinking about insurance not necessarily in a supply of goods context. So if you want us to cover up insurance and liability from a different perspective in the future, please pop that in the feedback box as well. As usual, we're going to aim to speak for 40 to 45 minutes, and we're going to aim to have 15 minutes for questions so that we can finish before or at 11 o'clock. The way we're going to run this morning's session is Tom is going to first pick up on insurance arrangements, like I say, in the context of business to business trading transactions. So predominantly in the context of a business to business supply of goods. And he's going to talk to you around the insurances available and perhaps give you some thoughts on particular considerations. Then the second half of this session, we're actually going to look at 3 liability clauses, and I'm going to talk to you about some of the things I would pick up on from a sort of commercial contracting perspective, and I'm going to have a conversation with Tom during that session as to particular insurance angles that also need to be factored in. And then, like I say, hopefully we will be able to deal with as many of your questions as possible. So without wasting any more time, let me hand over to the lovely Tom Filby to talk to you about insurance.
Morning all, thank you very much, Jayne. Welcome to my world, insurance. So I'm Tom Filby, Insurance and Disputes Resolution Partner at Mills Reeve, and I regularly advise on policy coverage issues following claims and losses, and also undertake non-contentious policy reviews and gap analyses. As Jayne just commented, we thought it'd be helpful to run through some of the types of liability insurance that may be relevant to your business and some of the key principles concerning the scope of cover under those policies. In many respects, insurance is what makes business possible. Without it, the trading risks would just be too great for many. However, and this is important, that does not mean that insurance effectively underwrites all of your business operations and decisions. Like any other contract, insurance policies have their own set of favourable and less favourable terms that have to be observed. And this is relevant both at the time of negotiating, say, a supply contract and also in respect of your reaction to any claim or loss that may subsequently arise in the course of a supply of goods or services. By way of illustration, I was recently involved in a matter that concerned the supply of machinery to a project in South America. The machinery had been manufactured and it was ready to ship, but issues on site and with the sub-purchasers meant that the customer advised that they would not be in a position to pay for the machinery if delivered on the date specified in the supply contract. So the customer made it very clear to the supplier they would not accept delivery of that machinery. The supplier wasn't content, and effectively, well, the customer was still confident, however, that the issues on site would be resolved and that there was a commitment to purchasing the machinery in due course. The customer therefore proposed a solution where they would pay for the storage costs for the machinery in the meantime. The supplier wasn't particularly content with that solution and went off to their trade credit insurers and advised them of the situation and told insurers that the supplier would be proceeding to effect a deemed delivery of the machinery to a nearby portside location, as the supply contract entitled them to do in situations where the customer refused to accept delivery. Assuming that there would then be non-payment of the equipment deemed delivered, the supplier then expected to recover several tens of millions for the machinery under their trade credit policy. Insurers took a different view on the position. They relied on a provision in the trade credit policy which required the supplier to take all reasonable steps to mitigate and avoid losses under the policy. Insurers said that engaging with the customer in respect to the temporary storage solution would represent compliance with that duty to mitigate, but that effecting a deemed delivery there and then would represent a breach of that duty to mitigate and would provide grounds to deny an indemnity in respect of any subsequent non-payment. The supplier's reaction was, well, I'm entitled to deemed delivery under the terms of the supply contract. So what's the point of insurance if I cannot do what I'm contractually entitled to? I won't spoil the fun for you all and say how this was concluded, but you can see the importance of understanding how your insurance interacts with your supply contract or any other trade-to-trade contract. They are two separate contracts, and it's not always easy to navigate a smooth path. Next slide, please. So, policy types. There's a huge array of insurance products out there, and these can range from SME focused all risks policies that seek to cover all of the main corporate and managerial liability risks, right through to transaction specific ones. The insurance you seek out and how you structure them will depend on the nature of your business, and you should engage an experienced broker to advise on this. I've set out on the slide some of the types of insurance that you're likely to consider as a supplier of goods or services. So next slide, please. Quite a lot of information on this one, but you'll get to take the slides away, I believe. Obviously, for the suppliers of goods, a key cover is likely to be product liability. And as you probably know, this covers your liability in respect of injury caused to third parties or damage to their property arising out of products that you have supplied. It's important to note, however, that it does not cover loss arising from damage to the product itself or its failure to perform its intended function. That sort of cover typically requires a product guarantee, which unfortunately can be expensive and carry a high deductible, or you might call it policy excess. Another key product is likely to be, or key policy I should say, is likely to be product recall policy. But again, this has its limitations. it requires that a defective product poses a real danger to health. It's not sufficient from a policy coverage perspective that the product is simply defective and the customer wants to recall it or wants to have it recalled, if it does not represent a genuine health risk. And that's irrespective of what the terms of your supply contract might say as to the entitlements for a customer to request the recall of products. It's also worth noting that absent a professional and advisory relationship between the parties, there is no cover under liability policies for what is termed pure economic loss. This typically refers to third-party financial losses, which are not in respect of injury or damage. So, for example, the loss of profit arising from a product's failure to perform as intended. There are some product liability policies that do contain financial loss extensions. Alternatively, you might find these as part of product guarantee insurance. So if you feel that this is the type of cover you need to be engaging with your broker to find out what cover you do have under your policies, and if it's not sufficient, whether you can obtain extensions. You'll also see on the slide there are some more peripheral but no less important covers, such as directors and officers liability insurance, or if you're providing design or advisory services to customers, professional indemnity insurance. I was previously involved in a matter where there were allegations of product liability against the manufacturer of a cleaning product that was said to have caused serious health issues. That in turn led to formal investigations being commenced against certain of the supply company's directors, to the extent that they were being threatened with extradition to submit to the investigation in Southeast Asia. Pretty scary prospect, I'd say. These matters were dealt with under the company's D&O insurance policy, not product liability. So it's very important, again, that you discuss with your broker the range of insurance policies out there and the limitations of each one, and ensure that you have in place a program of insurance that's appropriate for your business and also appropriate for your engagements with customers. Moving on to some key policy coverage considerations. The issues around liability and policy coverage, particularly in the supply of goods and services, is pretty fiendishly complex. And the most that I can strive to do in the course of a short webinar is highlight some of the basic underlying elements and principles that surround liability policy cover. First of all, in order to recover under a liability policy, the policyholder must establish on the balance of probabilities the existence of an actual legal liability, and in turn ascertain the value of that liability. The mere fact of allegations is not sufficient to establish the right to recover under a liability policy. Save that, in the context of a third-party claim against you as a supplier, firstly, be aware that allegations are nonetheless likely to trigger an obligation to notify insurers of the claim under the policy long before any liability has been established. Notification provisions are very important. Secondly, a policy will also usually cover defence costs incurred in addressing a claim, irrespective of whether a liability is yet or ultimately ever established. In terms of establishing that liability, strictly speaking, this means a judgment of a court or other adjudicator. It's important to note in this respect that a policyholder's settlement with a customer does not satisfy the requirement of establishing a liability, as this could be seen as a purely commercial deal that has been struck that is not linked to any actual liability. But that said, if matters have been notified under the policy properly and other terms complied with, any settlement will no doubt have been entered into with insurers' prior consent and with their agreement to indemnify the settlement. So in that situation, a settlement should not be a problem. Second, as you see has just come up on the slide, the legal liability must be one that falls within the scope of the insuring clause under the policy. And the insuring clause is that broad clause at the start that sets out in wide sort of general terms the cover being provided. In the case of product liability, the insuring clause will typically say something along the lines of the insurer will indemnify the insured against legal liability for damages or compensation in respect of injury to any person or loss or damage to property caused by the insured's products. The question of whether there's been damage to other property will largely be a factual one, but the scope of cover for associated liability and losses will often turn on a much more technical analysis. For instance, the phrase just mentioned in respect of injury or damage. This requires a much more direct causal connection between liability and injury than, say, the connecting phrase arising out of or in connection. And whole cases have been determined on this distinction. It's also very important to remember that liability policies respond only to tortious liabilities and those via statute. They do not respond to liabilities that are of a purely contractual nature and not concurrent with an equivalent liability in tort. So therefore, whilst under your supply contract, there may exist a very clear contractual liability to your customer, that does not necessarily represent a legal liability for the purposes of securing cover under liability insurance. And in that regard, it's important to note that it's the substance of the claim or the loss that is key, and not the way in which, say, a claimant has chosen to frame it. So for instance, in the case of Omega Proteins and Aspen Insurance, Omega inadvertently sold products that were fit only for disposal and not for supply. As a result, Omega was sued by its customers for breach of contract. Omega's product liability insurance said that the insurer would not be liable to indemnify Omega against any liability arising under a contract, quote, unless such liability would have attached in the absence of such contract. The claim against Omega was framed in contract only, and the judgment had reflected this. So on the face of it, it fell outside the scope of product liability cover. However, the reality was that there was a contractual liability against Omega Proteins that was concurrent with a like-for-like tortious liability that also existed outside of the contract that Omega had with its customers. It did not matter that the court had not considered or determined that concurrent liability. What mattered was that it existed. And it's available in this respect for an insurer or a policyholder to look beyond any judicial determination and to identify for themselves the true nature of a claim or liability for the purposes of determining policy coverage. Thirdly, perhaps worth taking a little bit of a detour at this point and looking at the question of part covered claims. So what happens if you as a supplier are facing a third party claim that is in part covered under your liability policy and in part not? So for example, just picking up what we're talking about, part of it relates to compensation for damages to a customer's property. But another relates to losses arising from a purely contractual breach. The short point is dual purpose costs. There's a principle that's been developed across liability policies, but is often little known about and little observed, and can lead to policyholders missing out on a fuller recovery of particularly costs than that to which they are entitled to under the policy or under legal principles applying to insurance policies. The courts have clarified that where the costs are incurred in respect of the defence of both insured and uninsured aspects of a claim, the liability policy will cover 100% of those dual purpose costs. It's not the case, as is so often assumed, that there should be a negotiated apportionment of those costs. It's only where the costs very clearly relate solely to the uninsured aspect of a claim that they fall outside the scope of indemnity. So this is perhaps one of those situations where common sense does not prevail, but to the advantage of the policyholder. So returning to our magnifying glass, the next slide. In terms of, I suppose, the final limb of key considerations on scope of cover, there are, of course, exclusions. Now, these can be very wide-ranging and numerous, and policies need to be considered very carefully by you as a policyholder to ensure that the exclusions do not carve out from the wide insuring clause the cover that your business needs the most. So for product liability policies, an obvious exclusion is that in respect of damage to the actual product supplied or the cost of repairing or replacing it. For product recall, key exclusion may be in respect of the efficacy of a product or a defect or contamination that does not pose a danger to health. And importantly, running through all liability policies, and we've already touched on this, is an exclusion in respect of contractual liability, or more specifically, liability that is purely contractual and is not concurrent with an equivalent tortious one. So for instance, a liquidated damages clause or a contractual provision that specifies a liability situation that would not otherwise exist outside of the supply contract. So it's easy to see how liability exclusions, particularly contractual liability exclusions, are a key consideration when drafting liability clauses in the original contract. And on that note, I have the pleasure of handing over to Jayne, who will go through some of the typical liability clauses that we come across, and we'll continue to take a look at how insurance may speak to these.
Thanks, Tom. So the first thing I should say is we're going to look at three clauses, all of which I have seen in supply contracts in the very recent past. These are business-to-business supply contracts where we have been supporting the supplier in their negotiations with the customer. So we're going to look at what I call a quality assurance clause, a product recall clause, and an insurance obligation clause. I'll pass a few observations and I'll get Tom's input as to how the clauses talk to insurance. So Kate, could I have the next slide, please? So this is a quality assurance clause. The first element of the clause sets out what the customer expects on quality standards. You will look at the next slide in a moment, but that talks then about the customer's remedies. But first off, what this customer is asking for is that the products supplied conform with the specification, comply with applicable regulatory requirements and applicable laws, are satisfactory quality and fit for purpose, and are free of defects in design, material and workmanship. And I'm sure lots of you are reading this and having many of the same thoughts that I would when I look at a clause like this. So from the commercial perspective, I think one of the first things I would be saying is, well, actually this needs to be time bound. So what is the warranty period that is usually given for the products? I would be asking about the specification and who is the originator of the specification. Is it the supplier, or is this actually a make to print arrangement? And I'd be potentially looking to qualify that compliance with spec. I would also be very interested in the end destination of the products in the context of the regulatory requirements and applicable laws, because potentially that's very, very far reaching, and I'm going to pick up with Tom in a moment on that. I would be picking up on fit for purpose and querying what is the purpose of the goods, and are they actually going to be supplied for that purpose, and looking to qualify that. I'd also be looking at this design element in 1.1.4 to understand, are we the designers of the product? And this probably links back to the specification point. So just in the context of the interaction of this type of quality assurance clause with what Tom has been talking about, Tom, to what extent are these quality assurances covered by a product liability insurance, a mainstream product liability insurance?
Yeah, thank you. So effectively not. They're unlikely to be covered. So as we discussed before, product liability will typically cover only damage that's caused to other property. So a customer's other property that they might already have in situ when your product is supplied and brought in. So if your widget catches fire as a defect and then damages other property, burns the warehouse down, then there would be cover in relation to the warehouse, but not the actual product itself. And I suppose certain quality specifications may obviously have a bearing on whether something happens that does cause damage to other property. So it's obviously important to be providing something and agreeing to provide something that is fit for purpose, that passes quality control, all of that. But if you are looking purely at is a failure to perform as effectively as possible or to perform in a way that is entirely fit for purpose, that is not something that a product liability policy will cover. For that, as mentioned earlier, you'd be looking at what's often termed product guarantee insurance. And I think I said that is typically a pretty expensive policy because it is providing a guarantee to your product, and it carries high deductibles. So that means that for every loss under that policy, you are likely to pay out a pretty chunky element before the insurance or limit of insurance starts to kick in and indemnify. So again, do not assume that product liability covers all liability relating to your product. That's the short point. Don't be fooled by that very general term. Look carefully at what insurance you do have in place. And again, I can't emphasize enough to get on board with a decent broker and to get their input and advice. They know what's out there and they will be able to work with you and your business to work out the appropriate cover to have.
And Tom, I mean, on the regulatory requirements at 1.1.2, I would be spending quite a lot of time talking to the clients about, well, how are these things defined, but where is the product going to go? Because that is very potentially all encompassing. Are there jurisdictional considerations in terms of policy cover as well that plays into the thought process here?
Yes, of course. So, I mean, the insurance policy is capable of negotiation like everything else, and you get what you pay for. Most policies you'd expect, or at least I imagine you'd be aiming for one that provides worldwide cover in respect of claims jurisdictions or where losses arise. And worldwide cover, I would say, is pretty standard and it's eminently available. And again, you have to consider in respect to your business what you're looking to do. It might well be that a UK or other specified jurisdictions territorial scope is sufficient. What I would say is, even in relation to worldwide covers, do pay attention to I suppose the small print. So for instance, the US and Canada, because of their big litigation culture and the pretty massive costs that lawyers incur in those jurisdictions, policies, I mean, across all liability policies will often include sublimited limits of indemnity in respect of claims and losses arising in those particular jurisdictions. And I'd also say it may be that if your business is, you make it, depending on how sort of much business you do in other jurisdictions, you may also want to consider seeking out local policies. So you have your master, let's say, product liability policy with worldwide reach, but sitting beneath it, you may have a program of local policies that fit into the master one, but are more closely adapted to the particular regulatory or legal regimes that exist in a particular jurisdiction. So it's worth having regard to that as well, whether you need that sort of level of cover.
Okay, thanks, Tom. And just finally on this one, just picking up on the design element and the extent to which that would or wouldn't be covered by insurance. And I'm assuming, how does a design element play with, for example, a professional indemnity insurance, which quite often sort of mainstream suppliers of goods don't typically hold PI insurance? So just interested in your, very quickly, your thoughts on that.
Yeah, as I mean, quickly, short point is probably consider PI insurance, professional indemnity insurance. If there is, I mean, I think if you are providing specific, let's say, bespoke, tailored advice to particular customers in relation to the products that they need, or designing and manufacturing products specifically for a particular client, then it strikes me that you're definitely within the territory of holding that kind of professional advisory relationship that could well trigger a PI claim if you get it wrong. So I'd say get professional indemnity insurance there. It's a bit more grey as where you might be designing products and supplying them, but you're doing so generically, if that makes sense. So you're just doing these things for a body of customers that aren't specifically identified as not bespoke. There, one might argue that you are not providing a professional service that would fall within that type of policy. And I think, just quickly, probably assume, but check, that all of your other policies will have a professional indemnity exclusion. They almost invariably do. So the onus is on you to plug that gap.
Okay, thank you. Okay, Kate, could I have the next slide, please? So this is a follow-on, and this is the sort of remedies for breach of those quality insurances. And again, many of you will have seen these sorts of clauses, effectively without prejudice to any other rights or remedies the customer may have. You've got to repair or replace the products or repay the price. And on the next slide, which we won't worry about looking at the moment, there is also the ability, if the customer has to source product from elsewhere, them recharging you all costs of doing so. So just a few observations from my perspective from the commercial side is, the first thing I would be looking to do is actually making these remedies the customer's sole and exclusive remedies. If I weren't able to do that, I would be looking to link any damages claims into any limits of liability. So, and again, the mechanics of repairing and replacing, because you see these things generically, and quite often the supplier will say, it's actually not possible for us to repair this, particularly as you know, we get into more sort of advanced manufacturing solutions and so on. Actually, the honest answer is it's a replace, and the honest answer is there is a lead time to replace, which may not coincide with 5 business days. But I think the key point here is this, trying to get it as a sole and exclusive remedy, or very clearly linking any consequent damages claims that fall out of a product, a breach of the quality assurances, into the limits of liability. So I think that's probably all we need to say on this clause. Kate, if we could skip okay, perfect, you've read my mind. Product recall, again, clause I have seen very, very recently. And what you're going to see through the next few slides is a clause that divides down into effectively dealing with customer complaints, so non-product recall, then product recall provisions and some mechanical provisions dealing with recall that the customer wants the supplier to abide by, and then guess what, a full all singing, all dancing indemnity. So the first observations I would have on this product recall clause is, again, we've got the without prejudice to the other rights and remedies, but essentially what this clause is saying is if the customer reasonably thinks there's a defect in goods and it's had complaints, then it can recharge their handling costs and any costs, expenses, damages that they pay out to customers. So that could be goodwill payments, but it could be other compensation. So naturally we would be looking to curtail this, and we'd probably be wanting to link this into a proper defect investigation mechanism, and we would be wanting to place some very clear limits in terms of the reimbursements that our client is responsible for. But Tom, very quickly, in the context of product recall, just taking this clause 2.1 on its own, from all the discussions you and I have had, my sense, and tell me if I've misunderstood, is that this 2.1 clause is not something that would usually you'd be able to call out under a product recall insurance to get coverage for.
Yeah, I mean, it comes, so each policy is different, and there'll be some with a wider scope than others. But the general principle is that, again, as I said earlier, product recall is tied in with a sort of a real actual or real risk of danger to health. And if you don't have that element, you'll probably find that your product recall policy won't respond. So if you are looking contractually to provide the customer with a sort of enhanced and greater ability to request a recall of products, then that is something that you either need to negotiate with your insurers as an extension to your product recall policy, or seek, again, potentially within a sort of product guarantee type policy, or accept that you'll be burdening that sort of loss yourself, and you're entering into these terms on with your eyes open on a commercial basis.
Yeah, it's interesting because quite often this type of clause does fall in the product recall provisions, and of course quite often, and to be fair, not so much when we're dealing with our in-house lawyer community, but often if we're dealing directly with more operational people, the response is, you don't really need to worry about this, we've got product recall insurance, without actually understanding the very serious limitations of those that type of insurance. Right, mindful of time, if we flick on to the next slide, because I think this is quite pertinent to the point you've just made. So here is sort of the meat of the product recall provision in this contract I was looking at, whereby it is if the customer considers the products are number one, defective, number two, don't comply with applicable laws, or otherwise pose a risk of death, personal injury or damage to property. And again, I think, from a commercial perspective, I would be looking to significantly curtail this. I mean, also one of the experiences I've had when discussing product recall insurance with clients has been that actually it is for the client themselves, potentially with their input from their insurer, to decide that a recall is necessary, not for a customer to dictate that a recall is necessary, and that sometimes actually mechanically the customer making the decision also has an impact on what happens with the insurance policy. I mean, that was a couple of very specific discussions, but that's worth passing an observation on. So in the context of that 2.2, Tom, what you're really saying is that your typical product recall insurance covers the death, personal injury element. It doesn't talk to just defective product.
Yeah, that's right. Again, defective products, you're looking at that product guarantee insurance. And I mean, you can see it from an insurer's perspective that you are producing a product. It's in principle, within your gift, within your power to ensure that that product is what it should be. And if you have produced something that is a bit off key, well, why should insurers be responsible for that? That's, to be blunt, I suppose, is your own problem, it's your own fault, rather than sort of almost trying to protect the third party that suffers loss because of something that you've done. So they're almost, you can view the likes of product liability and recall insurance as almost being for the benefit of the third parties rather than the supplier policyholder themselves. But again, there's insurance for everything. So you get that product guarantee insurance, but because insurers view it a bit in the terms I've described, they will say it's going to cost you. But again, your broker, I mean, I don't know what the price is. Your broker will and can hunt around for a good deal if that's something that you feel that you need.
Okay, next slide, please, Kate. I'm going to very quickly canter over this because quite often in recall provisions in contracts, we also find a lot of mechanical provisions as to what the customer's going to do and what the supplier must do. So I'm not going to go into it now because time's a bit against us, but actually I would be interrogating these mechanics to understand, can we actually do it? So for example, can we make batch records and product information available within 4 hours of notification? Do we actually know where all of the products are in our supply chain, for example? So I would be working through the mechanics of the recall to make sure that we can operationally respond to that. Next slide, please, Kate. I think this might be more mechanics. Okay, so I think let's move to the next one. So this is the meat of it. This is an interesting one. So most product recall provisions that you're presented with as a supplier will usually contain what I call an all singing, all dancing, full unlimited indemnity. And indeed, that's what this does. And of course, as a commercial lawyer, I would be looking to significantly curtail the scope of it, consider limitations and so on. But one piece I did want to pick out here was, and again, I would be picking this out from a commercial perspective, the indemnities from the supplier and its directors, officers and employees. I mean, there's a question about how actually they enforce that against directors, officers and employees. But actually, I wanted to just bring in directors and officers insurance and just ask Tom the question as to how does D&O insurance play to this type of clause?
Yes, it's a good question. I mean, it's a liability policy, like all the others, effectively. So it goes back to that issue of what is a pure contractual liability and those that may be concurrent with the tortious ones. So directors and officers owe lots of liabilities, typically to their own company, and shareholders or interested parties, but also to other counterparties and customers. But if the directors have, through an indemnity, such as the one on the slide, acquired a liability that would not otherwise be one that they attract under the Companies Act or elsewhere or on a tortious basis, then that would not be covered under a D&O policy. It would be excluded through the contractual liability exclusion. Perfect,
brilliant, thank you. Very finally, insurance, we will often see obligations on suppliers to hold levels of insurance. This is again a typical clause. I would be picking out in a supply of goods contract, what is the relevance of professional indemnity insurance? And we'd need to think about that in the context of the client's business and the products and so on. I would also be picking out the obligation to insure for a period 3 years after the end of the agreement. Tom, very, very quickly, how does that play out in the insurance world, that post-termination obligation?
Yeah, so the I mean, in terms of if you're setting limits or sort of minimum limits, again, it's there's no issue with that, provided you're not saying that insurers will be liable for more than they would otherwise be outside of the contract. So it's not like a liquidated damages clause. So there's no problem with that. It's just a case of negotiating the right limit with your insurers. Just bear in mind that a lot of the time you already have your insurance in place with a set limit. And either if a particular transaction requires an elevated limit, then you'll need to get maybe a one-off extension for that, or even a project-specific policy, or just renegotiate the terms. And I mean, in terms of extending the period, well, the types of policies that you take out ought to have in mind and ought to reflect the type of typical commercial considerations that apply, such as in relation to your liability period after supply of a product. So all of that should be reflected in your policies.
And I should just say the other one, of course, I pick out, and I'm sure lots of you have spotted it, is that 414. All insurance is necessary to cover all liabilities. And I always say to clients, that's you can buy lots of insurance, but you probably can't buy insurance to cover everything. And of course, as Tom has emphasized time and time again, you know, the more insurance you're buying, the greater the cost is. Kate, could we just flick on to, I think this is the last slide here. The other piece we see in insurance clause is customers' interest being noted on the supplier's insurance policy. In mainstream contracting, that just isn't economically viable. Of course, you can talk to your insurer, but actually it will come at a cost. It's probably, in my experience, it's more usual on large-scale projects, project-specific, where there may well be project-specific insurance or add-ons and so on. But we usually try and resist that. And another point is on 4.5, liabilities not being released or limited by the insurance policies that you have in place. Just a thought here, and again, this could probably be an entire session on its own, is when you are negotiating your limits of liability and your insurances, just consider the interplay between that and any sort of reasonableness test that may apply under UCTA. Of course, if you're specifically negotiating, you can take yourself out of the UCTA regime anyway. But just a thought process for you there, particularly if you're signing a customer's standard terms. So I'm mindful of time. I think we'll leave it there and we will take a look at some of the questions. Now, I was fortunate to be taking some notes of them, Tom, when you were speaking. So I'm going to deal with those first. And those we don't get to, if we can, we will try and come back to you afterwards. So somebody asked a really good question, actually, about public liability insurance and how relevant that is in the context of remote working or working from home. I mean, and I was, again, you're the expert, not me, but I was wondering, is that from an employer's angle? Because does that come down to employer liability insurance, Tom? Or
yeah, I think that's probably, you're right. I think it would be one of the other liability insurance covers. So employer liability, even sort of public liability, perhaps, that relates effectively to injury, particularly suffered by employees of a business. And yeah, you need to look at how the territorial scope is defined there, whether the definition of a workplace would include effectively your home where you're working from. It might well be that there are some policies that have not yet caught up with that, but that will clearly be a very hot topic at the moment. But I think in terms of product liability, that should not be a particular issue. I suppose interesting question as to whether, again, if employers supply their employees with products to use at home, I think that would again be an employer's liability matter rather than products. It's not business to business relationship.
Yeah. Okay. Interesting question here, and I've had the experience of the person who's asked the question actually, where they talk about, they come across the terminology of commercial general insurance and general liability insurance in the US corporate space. Now, I quite often see that if we're dealing with a US customer in terms of their requirements. The question here is, have we got reciprocal concepts in the UK?
Yeah, I mean, so a lot of people still refer to general liability insurance, but as you said, it is a US term. The equivalent here, it depends on who you ask, but typically it's regarded as product and public liability insurance that themselves often go hand in hand. So that would be what we're talking about from a UK perspective.
Yeah, and I mean, I would say when I see those from the negotiation side, I actually try and say, well, actually, this is what we have, and stipulate what we have instead, rather than trying to shoehorn or second guess what might map onto the insurances they're referring to. I mean, that's sort of a negotiation point, really.
I mean, general is a general term, and you don't want to be caught out by assuming that you're applying the US terminology when in fact someone else has something different in mind, and general includes a whole host of other types of policies. So I think, specifying is the safest course.
So somebody's asked, I think, a very, very good question actually, about if insurance doesn't cover contract breach claims, why do commercial contracts often have those insurance obligations in? I mean, my assumption is that is because people want to make sure, well, there's several arguments. A, you're dealing with somebody reputable who holds insurance, but B, that actually the tortious, anything that will map into tortious claims, Tom, will be covered by insurance. I mean, is that your sort of?
Yeah, I mean, it's one of those things. It's obviously commercial contract negotiation. You try and depending on what side you're on, crowbarring what you can and exclude from the other side. You can't. I think you made the point earlier. You can't insure every single scenario, every liability, every eventuality. So it's impossible to comply with something that requires you to be insured against everything. I think if you have that kind of clause, you probably need to tone it down in respect of the kind of the reasonableness, or maybe even specifying the range of liabilities. So maybe even pulling in that whole kind of tortious aspect. But I think you need to consider very carefully what is being required of you there, because then you might find yourself in breach of contract if your insurance doesn't respond in the way that it has, but your insurance has responded in the typical manner. There will always be gaps in insurance. It's not foolproof. As I said at the start, it doesn't underwrite all of your business operations and decisions. So I think that is a clause to probably, from a supplier side, to resist, or to at least soften in a way that it is acceptable.
We've had a couple of questions actually around IP breach of confidentiality insurance. So somebody commenting, we're often asked to provide this insurance. Somebody else commenting that we're often asked to give IPR infringement indemnities. And does professional indemnity insurance cover that type of risk? So on the second point, my gut feeling, but again, if I were talking to a client about it on the IPR infringement indemnities, I wouldn't be directing them to check their professional indemnity insurance, Tom, because typically that is advisory rather than IPR infringement. Am I right? Or
Yes, I mean, it depends. So again, there's a whole array of PI insurance, and if you are a business where IP is a big feature, it might well be that there are tailored PI policies that will factor that in and may provide some cover for IP infringements. However, most of the time, it's likely to be an aspect that's excluded from the scope of cover, and if you feel that you need that cover, you can obtain IP insurance, intellectual property, and you can do it either as cover in relation to the costs of defending your own IP if someone else tries to infringe it, and actually to sort of bring actions. So it can be quite an attacking policy in that respect, or a defensive IP policy in relation to the infringement or alleged infringement of third-party IP. So you're subject to a third-party claim, and you can get separate insurances for those, or you can get a combined one that covers all of it. So intellectual property insurance is probably something, if that's a real concern of yours, to be considering as a separate policy. Again, I defer to the better judgment of brokers. I'm not one, but yeah, it's definitely, IP insurance is definitely a thing that is a pretty current consideration. Seen lots of policyholders looking at that and insurers moving into that space.
And then just one final question, conscious of time. Somebody's quite rightly asked, actually, in what scenarios should product guarantee insurance be considered, bearing in mind the expense and the level of deductibles? So excess, Tom, and I mean, I would say this is probably fundamentally a business commercial decision, but I suppose there is, if you're launching a new product, that's something out of the ordinary, you might consider that, because you might feel that you understand less of the risks with those products. Or my other thought is, high value project specific activities. You got any other thoughts, Tom?
I mean, off the top of my head, no, I agree entirely with that. I think it's ultimately a business decision, a question of what you can afford, what you feel that you need, and to balance those things. I think it's a luxury to have the product guarantee insurance, and some may feel they need it. And I think, to speak up your point around, let's say, novel products or ones where the risks are uncertain, obviously the more uncertain matters are, the more difficult it might be to procure that kind of insurance, because the risk is increased at the insurer end. So rather than vanilla products for which product guarantee may be more affordable and easily obtained.
Thank you, Tom. So we'll bring this to a close because we are heading very quickly to 11 o'clock. So it remains for me to thank you, Tom, for participating in this session. I've learned things, folks, in preparing for this with Tom that I didn't know. So I'm actually very grateful for the insights myself. Thank you all for attending. Thank you also to the super team, the super team in the background who makes all of this run efficiently and make sure that Tom and I don't mess things up. So we're very grateful to Kate and Christine sitting in the background. And just once again, as this closes, please fill in the feedback, including sessions that you would like to see in the future. I've seen some comments in the Q&A already about things you might like us to cover in the future. So if you could pop those in the feedback, it means we capture them all and we use it to inform our programme going forward. So thank you all and have a really good day. Take care.